House flipping tax implications, what you need to know, and this was taken by Helene Mulder from May 2023 Canadian Real Estate Magazine. Now, in recent years, house flipping has gained immense popularity thanks to captivating home renovation shows and the allure of quick profits. Many individuals are drawn to the idea of investing in real estate and making substantial gains through property flipping. However, before you dive into this exciting venture, it's essential to understand the financial implications and tax implications involved. In this blog, we'll explore key considerations you should keep in mind if you're planning to start flipping residential properties. So, what is house flipping? House flipping is a term commonly heard in the real estate realm and refers to the practice of buying a property, renovating it, and then selling it for a profit within a relatively short period of time. It has gained popularity in recent years due to the influence of home renovation shows and the allure of making quick gains. House flippers often look for undervalued properties that have the potential to increase in value after undergoing renovations. This strategy requires careful analysis of market trends, budgeting for repairs and upgrades, and effective project management. Successful house flippers understand the importance of finding the right balance between investment costs and potential returns, maximizing their profit margins in this process. Tax considerations for house flippers can play a crucial role in the world of house flipping. And as a real estate investor engaged in property flipping, it's essential to be aware of the tax implications that come along with buying, renovating, and selling residential properties. Understanding the tax rules and regulations can help you navigate potential pitfalls and optimize your financial outcomes. Key areas to consider include capital gains tax, which applies from the profit earned from selling a property, as well as deductible expenses related to renovations, repairs, and carrying costs. Additionally, determining whether your house flipping activities qualify as a business or an investment can impact how you report your income and claim deductions. By familiarizing yourself with these tax considerations and consulting with a qualified tax professional, you can ensure compliance while maximizing your profitability in the realm of house flipping. Capital gains tax. Now, capital gains tax is a tax on the profit obtained from selling an asset, such as property or investments that have appreciated in value. The tax is determined by the difference between the selling price and the original purchase price, with specific rules and rates applying to various types of assets and holding periods. Business income tax. This is a tax imposed on the profits generated by a business entity, such as a sole proprietorship, a corporation, or a partnership. The tax is calculated based on the net income of the business after the deductible expenses. And the rate may vary depending on the business structure and applicable tax laws as well. Underused housing tax. Underused housing tax refers to a tax or penalty imposed on properties that are left vacant or underutilized for extended periods. The purpose of this tax is to encourage property owners to put their underutilized housing units back into active use and address the issue of housing scarcity and affordability in certain areas. Land transfer tax. Upon purchasing or inheriting land, a buyer is typically required to pay a provincial tax upon closing the transaction, which is based upon the calculated purchase price of the land and any outstanding mortgage or assumed debt. Canada Revenue Agency and new anti-flipping rules following the federal government's acknowledgement of the flipping industry's role in high housing prices. The Canadian Revenue Agency has initiated investigations and enforcement actions targeting unreported business income for flipped or assigned properties. Now, what is the proposed anti-flipping measure? The proposed anti-flipping measure is a regulatory effort aimed at curbing the practice of quick property flipping in order to stabilize housing markets. Under this measure, the government intends to impose strict regulations and potential penalties on properties that are bought and sold within a short period of time. The goal is to discourage speculative activity and promote long-term housing stability by discouraging the rapid turnover of properties for profit. But there are exceptions to every rule. Exceptions to this proposed anti-flipping measure include specific life circumstances such as death of the individual or a family member, household additions, relationship breakdown, personal safety concerns, serious illness or disability, work relocation or termination, insolvency, and home destruction or expropriation. Other financial considerations to consider when flipping residential real estate, in addition to taxes, well, there are several. There's other expenses that house flippers should consider when selling a property. Here are some of them. 1. Depreciation. Depreciation is a factor that impacts the tax liability of a flip property as it reflects the decrease in its value over time. Investors can use depreciation to lower their taxable income by deducting annual depreciation expenses. Nevertheless, it's crucial to remember that the depreciation deduction must be recaptured when selling the property. Financing. Another one is financing. Financing is a crucial aspect for investors. They often rely on loans to secure the necessary capital for their projects, with options including traditional bank loans, private lender loans, and hard money loans. Track expenses for track purposes, keeping thorough records of property-related expenses such as purchase price, renovation costs, home office expenses, and legal closing costs is crucial for investors. By deducting these expenses from personal or business income, they can effectively lower their tax obligations. So, in conclusion, real estate investors must approach their financing options with careful consideration and an understanding of the associated costs. While the prospect of making substantial profits in real estate transactions is undoubtedly appealing, it's equally crucial to stay mindful of the tax obligations outlined by the federal government. By doing so, you can avoid any legal troubles or penalties down the line, ensuring a successful and compliant journey in the world of real estate investment. Remember to stay informed, make wise financing decisions, and keep those tax considerations in mind. We wish you all the best on your real estate investment endeavors. And my name is Danny Green, and I'm with RE/MAX First MV Real Estate Group. And if you'd like more information on tax implications, you should speak to your accountant. But if you're looking at finding a property that you can flip or a potential investment, feel free to contact me at danny@calgarysagent.com. My phone number is 403-605-6626, or you can reach out to me on social media. My handle's @Calgary'sAgent, or you can just look me up on Facebook.